So what we know is that the central banks around the world, the Fed, the European Central Bank, well, eventually the European Central Bank, the Fed and the Bank of England particularly, kind of early on in the financial crisis, they wanted to get new money into the system. And the question is, what's the best way of doing that? What they didn't want to do is to get it into the system the same way that Robert Mugabe did, which is basically he told his central bank to print in money, and then he went and spent it. And the net result of that was the $100 trillion Zimbabwean note, literally. So it's kind of what they wanted to do was to find a way of injecting money into the system so that they could get it back out again if they needed to, so they could reverse the process. And what they came up with this was the idea of, well, firstly, what we do is, we create new money. And in the olden days, kind of 100 years ago, the way we would have created new money is we would have got a big printing press and gone and printed millions or billions of pounds worth of notes. But these days, the central bank doesn't need to do that. It can simply create it. It's as simple as that. They can simply electronically create money, which sounds weird, but it's not really any different from taking sheets of paper and printing numbers on them. They can do that. They could physically print more notes if they needed to. So it's simply the modern equivalent of doing that. So we now got new money, and all that's doing is at the moment it's sitting in the Bank of England. It's not doing anything. If I printed a lot of money, and all I did, is I kind of euros, and all I did was you can't see that, and all I did was stick my money, in my very cute pen bucket, and then simply left it there, then that would have no effect on the economy. It wouldn't do anything. It's not the banking system. It's not being spent. It's not creating demand. So we've got to find some way of getting it out into circulation, other than just giving it to the money and giving the money to the government, to spend, because that way lies madness and death. So what they decided to do, was they decided to get the money into circulation by buying existing government bonds. Now, we know what bonds are from the fiscal policy walkthrough, so I'm not going to go into that in further detail here. But we buy existing government bonds, but not from the government at the moment. Or not at any point up to this point has this been done. So we're not giving the government money. We're buying existing government bonds from financial institutions. Pension funds, insurance companies, banks in principle, and so on. They also bought some. They also bought some corporate bonds, but essentially, we buy the Bank of England, at least. It essentially bought UK government bonds. And it bought them from, as I say, existing financial institutions. So it's not lending the government any money. There's no more borrowing being done by the government than there was before. All that's happened is that the government now owes money to the Bank of England instead of owing money to pension funds and insurance companies. So what we've done, is we've created new money. We've used that money to buy bonds. So what's happened is that the bonds have gone to the Bank of England, and the cash has gone to financial institutions. And the government isn't really involved in this transaction at all. Once upon a time, a long time ago, the government sold these bonds, but that's irrelevant at this stage. So all that's happened is the Bank of England has swapped cash in exchange for these bonds, these IOUs that were issued by the government some time ago. But the Bank of England, it didn't have to buy bonds. It could have bought marker pens. It could have bought iPhones. But it didn't do that, because it's kind of, well, what the hell are you going to do with, £640 billion worth of pens? If nothing else, you need a big storage space to put them in. So they wanted something that there was a lot of, that was convenient to store. So what are the effects of this? the obvious effect, which we'll come to in a minute, is that there's more cash. There's more cash in the system. Yeah, but we'll come to that in a minute. Yeah. What the Bank of England describes QE as is an asset purchase scheme, which is fairly obvious because guess what? The whole point of it is that the central bank purchases assets, and the asset that they buy in this case is UK government bonds, or in the Fed's case, US government bonds, and so on. So what happens? So firstly, what we know is that there is an increase in the demand for bonds. It's an increase in the price of oil goes up. It's an increase in the demand for gold, the price of gold goes up. If it's an increase in the demand for bonds, then the price of bonds goes up. And that has an immediate effect, which is that other bondholders, the people who didn't sell, they have an increase in their wealth, which increases confidence, and therefore they're more likely to perhaps consume, invest, and so on. So other things being equal, we might expect consumption to rise. So the direct effect is there are increases in the price of bonds. That's an asset. People are wealthier. AD rises. Secondly, because there is an increase in the price of bonds, as we identified there, what we know is that there will be a decrease in their yield. So if you remember yield, so yield was this. Was this idea of I'll give you a quick. I'll give you a quick reminder of yield. So yield basically says that bonds pay a fixed amount of money. Say a bond pays £3 a year. Say in 2020 it pays you £3. In 2021 it pays you £3. In 2022 it pays you £3, and so on. Yeah? Your yield says, well, my percentage return, effectively my interest, the rate of return I'm getting depends on the price that I pay. So if in 2020 the price of a bond is 50 quid, then I'm getting 15%. No, I'm not. I'm getting 6%, sorry. If in 2021, so 3 over 50 times 100, If in 2021 I'm getting £3, 3 over 100, that's 3%. If in 22 the price of the bond is 200 quid, then I'm only getting 1.5%. That's bond yields. So what that means then, is that so what we're saying is that yields on bonds have gone down. And therefore what that means is that for new investors coming into the market, they don't like the look of bonds. So new investors, they say, well, the yield on bonds is crap. The yield on bonds is really weak. So they don't want them. So new investors, their attitude towards bonds is a sad face. So what they do is that they therefore buy other assets. Other assets include things like shares and property. So what that means, is that there is an increase in share prices. The price of shares in companies. There is an increase in house prices. And other property prices and so on. So there is a second wealth effect. So again, there are further increases in wealth across the system. And again, that can increase confidence, it increases your ability to take out loans, it increases collateral and so on, And it also decreases the yields on those assets. And what that means is, we said thirdly, there is an increase in cash in the system. And because these other assets are starting to yield less, people are going to be increasingly keen to hold cash in the banking system. And therefore, because there's more cash available to be lent, we're likely to see a decrease in interest rates on ordinary bank accounts as well. So it leads to increase in bond prices, which has a knock-on effect on bond yields. That has an effect on the prices of other assets, and because there's more cash in the system, that puts downward pressure on interest rates. Furthermore, so further interest rates, not just base rates, But remember that the central bank, it didn't think that that effect was going to be the most important one, because interest rates were already close to zero. So what they were hoping was that the confidence and the wealth effects that were created over here, would make it easier for companies to borrow, because share prices are higher, it becomes easier to sell shares, but also just higher levels of wealth are going to increase the total level of demand. So what's not to like? So not everybody is a big fan of QE. Not everybody has kind of said this is a great idea. And the reasons that QE is considered to be problematic are, firstly, it's led to arguably what's happened is we've got asset bubbles. So there is a risk that these are going to burst. In other words, that we create a huge increase in share prices and housing prices, and they're just going to burst and pop. And that's going to create problems in the future, much like the financial crisis did. And B, it's obviously led to a big increase in inequality. So people who have assets, they have done well. So people with property, people with shares, rich people, in other words, they've benefited a lot from QE. If you haven't got any assets, then you haven't really benefited so much. So there's this idea that we're creating bubbles, which creates a risk and also is driving up inequality. Secondly, obviously it's leading to a big decrease in interest rates, on savings. So any ordinary person who does have savings, any ordinary person who's trying to save for retirement or something like that, then they're getting screwed. Anybody who's trying to live off their savings, interest rates are basically zero. And what that's done is it's also encouraged risk-taking behaviour, by investors. So instead of keeping money in safe places, more and more money has been going into speculative schemes. And some people have lost a lot of money, by shooting for the moon, putting money into these schemes that are advertised to them to give them good rates of return, and just getting scammed. So together with the large amounts of information asymmetry in financial markets, that's potentially a worry. And the third worry is just this idea that, there's kind of, in the long term, you've put a lot of money into the system. There is a worry, that it's going to create inflationary pressure in the longer term. And as a result of that, so in other words, people are fearful of the the Robert Mugabe Zimbabwe scenario. Although in principle, remember, QE can be reversed. But anyway, so those are the usual criticisms, of quantitative easing, and also that you're simply allowing inefficient firms to survive, that you're keeping interest rates so low, that zombie firms, the living dead, firms that should have gone out of business and their assets been used elsewhere, they're kept alive on this kind of low interest rate, cheap money kind of lifeline, and as a result, the economy is less efficient, in the longer term, because if these businesses had died, then their assets could have been used elsewhere. It's possible to unwind QE or to reverse QE, and that simply has the reverse effect. So sometimes this is called QT or quantitative tightening, and all that involves, is that the Bank of England, it sells bonds. So the bonds that it already has, it sells the bonds it bought back to the system. So financial institutions, what now happens is that cash goes back to the Bank of England, which it destroys, and bonds go back to financial institutions. So we simply reverse the process. And that will then put downward pressure on asset prices and so on. The worry is that if they do it too suddenly, it'll create a collapse, but presumably they're not that stupid. So in principle, they can reverse it. So therefore, your argument about inflation is maybe not quite so strong. So the usual arguments are what it's done to savers, and also the fact that it's driven up wealth inequality, particularly wealth inequality within the system. And that's okay. Come back.